So let's take a look at the classics. They're saying it's time to return. The classic buy the dip method. We've been talking about that for a while. And then the fear and greed index, a good market indicator, part of why we talk about it every single video. I like it a lot. It's a good metric. And then government bonds, prices starting to rise with every whiff of bad economic news, and the 60-40 portfolio starting to outperform at least a little bit. So dips between 5 and 10% happen on a yearly basis. They might turn your stomach a little bit, but typically they're good market money-making opportunities. The last time we saw it here, you can see markets did show a lot of strength after that time period, and you can see net inflows, markets buying up that dip, especially on the institutional side. Retail investors also buying it up. Big money flows. You can see $14 billion flowing into equities in the S&Ps on that August 5th dip. And part of the drop was actually triggered by these hedge funds. They were holding $450 billion and went to holding only $250 in July. And that was part of the trigger that saw that volatility